don't have too much content in regards to the April 10th meeting, mostly because it's kind of a consensus as to what they're going to do. It's expected to be a hold. Most people think that when and if rate drops are going to come, it's still expected for June, but I am kind of just telling people, hey, you know what? Yes, it is expected for June, but I wouldn't be surprised if they hold out longer. But again, you know, if anything changes in terms of, you know, the consensus, of course, I'll let you guys know. So in terms of everything, yeah, okay, here we go. So in terms of everything for CPI, we have the next report coming out April 16th, but I believe a couple of weeks ago, Sergen was kind of able to come up here and, you know, break down the different, you know, services inflation, you know, gas, like he really broke down all the different, you know, categories that go into inflation. I'm just going to generalize it a little bit here for you guys. Inflation going down. Of course, there's a lot of volatile, you know, measures that are, you know, that lead to this, but you know, it's expected to continue to cool. The numbers, as you can see, are looking good, and for February, 2.8 was below expectations. So again, that's what we want to see. It's going in the right direction. It's just it's really just going to be a matter of time until, you know, inflation gets to where it needs to go, and we're able to, you know, get rates a little bit down more. Now, in terms of where are rates right now, Bank has kind of overtaken TD, whereas TD was the rate leader last year. Scotiabank has been able to kind of get back in line. Again, this is what we're seeing on the rate sheets originally. This does not include the rate discounts that we would inevitably be able to get. So we can likely do on a 3-year probably close to 505, 515. But again, that's going to be on a per deal basis on, you know, depending on how big the deal is, credit, income, you know, a multitude of other factors, right? But again, on a month-to-month basis, it is down. I will say bond yields have spiked a little bit in the last week and a half. So that will kind of impact, you know, the rate discounts that we are able to get for clients. But again, looking at things from, you know, not necessarily, you know, with a magnifying glass on a week-to-week basis, kind of just pulling back a little bit. Hey, you know what? Yes, the last time that I was here with you guys, rates have decreased since then. So again, more good news on that front. Now, the last thing that I wanted to bring here for you guys, again, I'm not going to, you know, talk for too long, but there was some news that came out of OFSI, I believe around March 25th. So OFSI is considering implementing in Q1 of next year new guidelines in terms of how to qualify people for home purchases. Now, right now, borrowers qualify with debt to income. So on a monthly basis, hey, what is your gross income versus how much debt are you carrying? Not only the subject property, the debt that you're going to be carrying on the subject property, but you know, credit card debt, car loans, et cetera. All of that is taken into consideration right now, and you can go up to, you know, 44%. In some cases, you can go all the way up to 50%. So the new guidelines that OFSI is implementing, again, it's still a work in progress, but they are looking to limit it to whatever clients, I mean, the buyer's household income is, limiting it to 4.5% of that. So if clients made 100K, then they would be limited to a mortgage amount of around, you know, 450, 500-ish, whatever 4.5 is. So again, right now, we wouldn't see too much of a change in terms of how does this impact people's buying powers. As of right now, with rates being elevated at 5%-ish, we're typically seeing, you know, borrowers are able to get around 4% of their buying power. Of course, I'm generalizing things. It's on a case-by-case basis. But I have an example that I'll bring to you guys in the next slide here. You know, when rates were at 2%, you know, let's say 2-3 years ago, borrowers were able to access around maybe, you know, 5 times their income. Again, I'm generalizing things, but this will be, you know, a pretty big change in terms of how to, you know, qualify people. But we don't have the full picture. I wanted to bring it to you guys here first today and kind of share what it is that I'm seeing out here. Again, this is only going to apply for purchases as of right now. Again, as things get, more, as they have a more concrete plan, I could see that being extended to renewals and refis especially. This only applies to federally regulated banks. So again, working with mortgage brokers that have access to online lenders, credit unions, et cetera, that will be ever more important, especially as we go into next year. And the LTI calculations, it stands for loan to income. I forgot to mention that. But so it's going to consider the global amount. So if you were to get a second mortgage on the property, or if you're getting a mortgage plus a line of credit, all of that plays into a factor. Next here, oh, whoops. Okay, here we go. So right here, I have just some rough calculations on a $500,000 purchase. What you'd be able to see today, before the rule changes with what we have right now. Of course, the TDS is around 43. Like I mentioned to you guys before, we can go up to around 44%, right? Now, again, and that's for qualifying for a home purchase of 500K. After this rule changes, I'm assuming that rates have dropped. So I've included an interest rate of 3.5 here. But again, as you guys can kind of see, they can qualify for less house, right? So again, this is kind of something that OFSI is implementing to kind of rein people back and continue these not so elevated levels of home buying capabilities. It'll be interesting to see what exactly the policy is once there's something more concrete. But again, that's kind of the framework that we have today. So any other questions? That's about all I have for you guys today.
So that's absolutely coming into play.
So not everything that I mentioned to you today, again, it's not 100% concrete. So there could be, some details that I'm missing or some details that are changed around, but they're implementing it to kind of get some feedback from the industry to see how this would play out. And then they'll go from there. Changes are coming. So what capacity we see those changes, that's yet to be determined. But yes, something in and around what I've mentioned to you guys today is likely going to be on the table and coming into effect Q1 2025.
Justin, I was reading about this last week, and from what I was reading, the primary reason they were implementing it was because of investors and purchases and what the banks have on their books. So it wasn't driven necessarily by, a one-off home buyer being approved at a 5% rate. It was more they were concerned about what the TD Bank, Scotia, et cetera, have on their books for people who've done, investing across the board. They've leveraged more, their properties.
Yeah.
And domino effect.
Yeah, that's a great point. That's a great point. One thing that to expand on that, the OFSI is not going to be looking at the individuals that are purchasing the house to implement penalties if they were to go over this. They're going to be looking at banks and their specific portfolios of loans. How many percentage of their loans are over 4.5%? I believe right now they're going to cap it at around 25%. Like they would want 25% of the mortgages in their portfolio to be like a max of 25% over that 4.5 times people's incomes. Banks will have discretion to be able to use exceptions in certain cases. I'm sure those exceptions might come with a higher rate to offset the risk that the bank would be taking on because now clients are more leveraged, right? But again, all of these details are to be determined. If banks do over leverage themselves with a higher or a riskier portfolio of mortgages, then we could see penalties divvied out to banks on a per bank basis. But again, all of this, again, it is to be determined. But yes, that is a great point. If they're not actually going to be penalizing the individuals, the home buyer, the clients, this is more so going to be something to rein in the banks, the federally regulated banks, and can kind of keep an eye on their portfolios.